Done. All right. Welcome back again to our continuation of the discussion of business and technology. So this is a continuation from our last class. We are talking about the macroeconomic factors, and this is one of the aspects we talk about government employment policies. And these government employment policies has an implication to the overall macroeconomic condition of the given regime or a country or a region. So here, government has several options to create jobs or reduce unemployment. Spending more money on government staff. They spend money on the government so that the staff is more motivated to work. Encouraging growth in their skills, education, the country's infrastructure, and so on. Encouraging training in job skills. Offering grants to employers. When you hire people, we give you different offers, tax benefits and different offers. Encouraging labor mobility. Like in Middle East, a release system. There no more NOC, you can change jobs. So these are some government implications. Economic growth. Economic growth may be measured in increases in real gross national product per head of population. So factors which contribute to growth include new investment, natural resources, like for example investment in infrastructure, air, minerals, labor sources, levels of education, capital availability from overseas or locally, or like now in Sri Lanka we talk about IMF. Technological process, example new technology from internet and so on. The four main objectives of economic policy: to achieve economic growth, to control price inflation, to achieve full employment, to achieve a balance between export and import. Actually here plus. This answer must be a plus. Policies. The problem with trying to satisfy one objective is that it can lead to a problem with another. It's always a disputing of overlapping or conflicting. So to manage this, the government manage these objectives with fiscal policy and monetary policy. So just to understand, before understanding the policies, again we just try to reiterate. See, this is a government, this is the organization. In between the interactions are overall economic policy, market demand, cost of finance and taxation, and these have implication to organization. Industry policy, protection versus free trade, like trade zones and so on, grants, incentives and sponsorship, regulation, entry barriers and capacity, and these will have, through industry policy, will have implication to organization. Environment and infrastructure, distribution, that has implication to organization. Social policy, workplace regulation, employment law, labor supply, skills and education. For example, race, discrimination, sexual discrimination, all that will come here. Foreign policy, trade promotion, export credits, European Union and GATT obligations, export promotion to ELIS aid recipients. So when developing the economic policies, both fiscal and monetary policy, we have to factor these aspects. So government influences over economic or commercial decisions are output capacity. Now when you wanted to maximize output, you also just try to provide additional grant or allow tax incentive to invest. Competition, forbid or allow takeovers or mergers. Now for example, if you remember in Doha, we have Uridu. So long time only Uridu was there. Then the prices are always big. Then they allow Vodafone to come in, then the price has gone down. So this is type of incentive that the government is giving to the country's economy. Outlaw anti-competitive practices and opening market to new entrants. Monopolies, break up them, regulate them. Sales demand, government policy affects the demand. Or operational decisions, influences of operational decision, health and safety, employment, consumer, tax. So legislation, regulation, equal opportunity legislation, product safety standards, sales tax, income tax, accounting, control. Now what is fiscal policy? A method of managing aggregate demand in economy. Now aggregate demand is the total demand in goods and services. Annually we set out a budget. The government can increase demand by increasing its spending. Like for example, putting up a bridge, highway, building from Kurunegala to Colombo, increasing and decreasing tax. So if by doing these two, the government can increase the demand, because if you set up a new project or if you spend more, then the public will tend to engage into more active investments. And also if you decrease the tax, further the more incentive for people to invest. What are the types of fiscal policy? Taxation, public borrowing and public spending. These are the three aspects. When you talk about fiscal policy, it's mainly the taxation and public borrowing and public spending. The functions of taxation raises revenue for the government. To cause certain product to be priced to take into account their social costs. Example, cigarettes. To redistribute income and wealth. To protect industries from foreign competition. There are two types of tax, direct tax and indirect tax. Direct tax is, obvious example is income tax. The person who is suffering the tax and the person who is paying the tax is same. Usually proportional and unavoidable taxes paid directly by person to revenue authority. Here, collected via an intermediary. Okay? And one person will pay, but he will not suffer. Understand me?
Right.
So there are two types, specific, fixed sum per unit or $1 or fixed percentage. Good example for indirect tax is VAT. Though very soon VAT is coming. If you have a doubt, you can talk, otherwise I will be going in this speed, okay? Monetary policy, a method of influencing aggregate demand in the economy. Types of policies are money supply, monetary system, interest rate, exchange rates and availability of credit. In Sri Lanka, it is a good time, good situation to give an example about inflation. Actually, I saw one video and I am just going to give the summary of that video. How you can understand the inflation, a huge increase in inflation in Sri Lanka. In Sri Lanka, what happened? Actually, this is a copied, I am just reproducing a video that I saw from YouTube. Let's say this is our country, and here we have 5 fruits. Let's say apple. In Sri Lanka, this is the resources we have. Only 5 apple. Each apple costing us $20. How much it's costing us? The total cost of producing these 5 apples from the farm, land and everything, at the end of I am having the apple in my hand, it cost me $20. So total how much resources we have? 100. So someone to buy this apple, each need to pay how much? 20. Each 20. So we need $20 note. And we need how many $20 note? 5 $20 note. This will give us, this is the money available in the country. This is the resources that is available in the country. So this will give a balanced economic situation in the country. So we are proportionately printing money to manage with our available goods and services within our country's production. Now, our so-called finance minister, Kapotas hit the plan. What he did, he went on to produce another set of $20 note. Now, in the public hand, how much money they have? 200. But how many apples we have? Only 5. So let's say this 200 is in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 people's hand. Before it's only in 5 people's hand, $20, 5 apples, no problem. Now 20 people, so 10 people each have $20, but we have only 5 apples. So everyone coming to buy this apple, the seller, the shopkeeper who is selling the apple, now he understands that people are asking more on this. So does he have enough? No, what he can do now, he will increase the price. So this price increase is due to inflation. This inflation is known as demand push inflation. Demand is pushing. Now here too much demand. People have money, but don't have goods and services to buy. So whatever the limited resources available to sell, the people who are selling increasing the price. So that is exactly the inflation is. So when you deciding to print money, the country's money supply must be proportionate to that country's resources. It should not be that huge variance in the what you call money supply. So the monetary policy will have influencing aggregate demand, which will include money supply, monetary system, interest rates, exchange rates, and availability of credit.
Can you explain how the interest rate is affecting this?
Now, when let's say the bank is charging high interest rate. Now we are talking about the monetary policy. Yeah? So one of the monetary policy is to tackle with the interest rate. If the bank will increase, central bank will increase the interest rate. Let's say they are increasing the borrowing interest rate. So one person to borrow and another person to invest. So when the borrowing rate will be high, would the people will borrow money? No. If the people don't borrow money, can the people, is there any use of investing in any bank? No use. You understand me? So that will then again bring a mismatch. You get me?
Right.
So this has a close relationship to the monetary, and if I have too much money in my hand, interest rate is high, and no, because too much money is in my hand and people will not be available to borrow. And the money that I have in my hand is no use, no one will take it. It's just another printed paper, that's all. In Zimbabwe at times, they use the printed money as a toilet paper. It has gone into that extent. Clear? Balance of payments, we have actually three accounts: current account, capital account, and financial account. Before we come to this, these are the two main accounts we have. Current account are the balances in trade in goods, trade in services, income from residents employed, and capital investment in other countries, like we sending money to Sri Lanka. Transfers from interest payments and non-government payments to or from bodies in other countries. So the total of all this is current accounts. Capital account, public sector flows of capital, like borrowing. The Sri Lanka went to India to borrow $1 billion. So the total of this, now this is actually to manage the balance. Flows of capital to or from non-governmental sector. Non-governmental NGO sector, and then the total of all this will result into these three accounts. That is the balance of payment that we will calculate. The sum of the balance of payment must always be zero. This is achieved by a financial account, as I told you. The total, if you take the total of current account, capital account, and financial account, must be zero. But if you remove the financial account out, it will not be zero. If the total of the current account and the capital account is a plus, then the financial account will become minus. If the total of the current account and the capital account is minus, then the financial account will become plus. The balance of trade is the surplus or deficit in the current account only. In the current account only. Here. The balance of trade is surplus or deficit is the result in the current account only. Deficit, what do you mean by deficit? Import is greater than export. Surplus, export is greater than import. This is a favorable desired situation.
This is basically trade deficit and
Trade surplus. Rectifying a deficit. How can we rectify? A deficit on a current account may be rectified by one or more of the following: depreciation of the currency, devaluation. This is what happening in Sri Lanka now. Direct measure to restrict imports such as tariffs or quotas. Now that also Sri Lanka tried. Domestic deflation to reduce aggregate demand in the domestic economy.
Domestic deflation.
Deflation to minimize the aggregate demand. When the prices are increasing, people amount of demand will tend to reduce, isn't it? Artificial hike of the price. Now the gas cylinder, before it is some 1,900 or something, now it's almost 4,000. So people now resorting to firewood system or what do you call that, kerosene oil burner. So these are some measures to rectify the deficit. And that concludes this chapter actually. And can you try this question? You want me to share or you already have?
I have.
Okay.